Welcome back. You're with us here on Trading Hour. Well, the market's up about, 32, 33 odd points or so. So it's recovered quite a bit from the day's low. So it's a pretty good outcome given how we started. 16,390 or so is where the index finds itself at. Now, on the sidelines of the Motilal Oswal Ideation Conference 2022, we are now joined by a very special guest. Raamdeo Agrawal needs no introduction. He's chairman and co-founder of Motilal Oswal Financial Services. Raamdeo, it's a pleasure for us to have you on the show, on the program. Thank you very much for joining us. Raamdeo, I would like to sort of divide this conversation into a couple of parts. I know that since the last time we spoke, your view on what lies ahead for markets has darkened a little bit. You're not as optimistic on things as you were the last we spoke. So I want to start there. What has caused this shift? What are your top worries right now?
So good morning, Prashant. One of the things is that we are passing through unprecedented global uncertainties, and I think equity as an asset class is headwinded worldwide, not only in India. And our problem is compounded by two things. One is the oil price, and second is the FI selling. And FI selling is function of what's happening in other parts of the world. So I think, at the same time, we have very strong earnings growth happening. So that's how these two forces, one tailwind and two, three headwinds, they are pulling each other, and market is stuck in a range-bound kind of fashion. So that's what looks to be, and I hope this oil price, which today is showing about 123, 124, doesn't go to some of the commentaries we saw about $140, $150. I think that could be quite scary for rupee to depreciate, and I don't know what other collateral damages it will do.
But that is hope, right? What is your view? Because viewers will be very interested in trying to understand how you are looking at this entire scenario. And in terms of probability of outcomes, according to you, what is most likely?
Yeah, so one of the things is that these problems are compounded by this Russian war. And we thought that war will be over in, say, a week's time or 10 days' time, which has already crossed 20 days. So hopefully, not in too distant future, I think this war should come to an end. So that will give the first relief. Till then, I think it's a wait and watch. Things are becoming, kind of far more strenuous. And so I don't think till something changes in the current setup of the risk and challenges, I think the markets will remain quite stressed, I would say, because our problem is directly coming from FI selling. Yeah, that is not going to abate if the problems remain. So I would remain very cautious in the market, very careful in what I buy, at what price I buy. Though the longer term, I'm fearless in terms of buying good company at reasonable price. But that's the big challenge. All the good companies, they have gone through the roof, and so as the stocks are coming to reasonable levels, I think I won't hesitate and buy even now. But my general expectation from the market in the short run would not be too optimistic.
So I have to ask you to put numbers to it, Raamdeo. Two things. One, so very careful, very cautious, market to remain stressed. So where do you think the index kind of starts to base out a little bit? And when you say short term, what kind of time frames are we talking about?
I think even in this stagnant index, if it remains between 16,000, 18,000, or maybe 15 and 17, I think there's a lot of sector churn which is happening. A lot of sector churn, stock churn is happening. Even style churn is happening. In the sense that the kind of stocks which were doing well earlier may not be doing well now. So I think and a lot of stocks which we never thought that will come to the levels, they are coming to those levels now. So clearly one has to rethink what is going to work in the post-COVID and post-war world, because a lot of things are changing, and like energy sector was not that much in forefront. Now today, energy is all over. I mean, the only sector which is winning is the energy worldwide. Unfortunately, we don't have great companies listed here, but globally, if you see, all the oil companies, gas companies, they are minting money. So clearly, my strategy would still be to look for stocks at reasonable prices, and stock may go below that price also. But probably this what you call temporary spike in the uncertainties will give good opportunity to buy good companies at reasonable prices.
Okay. Now, so just to link these two things, right? Strategy would still be to find good companies at reasonable prices, which brings us to valuation, which in turn brings us to earnings. You in your first answer, you said thankfully earnings in India are still quite resilient, right? So that's the positive side of things. Is that also likely to come under some pressure? Because as you said, it's pretty unprecedented. So estimating earnings 1 year, 2 year out, and then basing valuations on that, I mean, that becomes a bit of a mug's game. Your thoughts?
Yeah, so I'm really, when I talk to the analysts, they all talk about 24 earnings. We are not sure about the next quarter. And there is a lot of, because what is happening is some of the companies, they have done so well in last 2-3 years that their multiples based on last 12 months earnings or current P multiples are looking unattractive. And hence to make it look attractive, analysts are taking shelter in 2024 earnings, 2025 earnings. Some of the earnings estimates I have seen up to 2030 also for some of the digital companies. So that is, kind of a bit of too overstretched. I think what we have to see is that current P multiples for the current year, or at best, what is expected for 2023, if the first normal year post-COVID. I think if those numbers become reasonable, that's where I think one should. And now the market is not in the runway situation where you were feeling missed out, earlier. Now you can actually little more patience can be observed, and you can wait for your stocks to come at your price and buy. The only issue is that when you buy the stock at say, what is that 125 comes to 100, you buy at 100 as a target price, it might go to 85, 90, and one should not be worried about that particular fact, because once all these incentives which are at peak right now, they will subside. Now, when will they subside? I don't have timeline. And that's where I think the people with a lot of patience or private money, they will have upper hand than compared to people who are impatient.
You think in an environment like this, better to fall back on trailing earnings? I mean, to arrive at valuations?
Yeah, I always look at trailing earnings. I start my valuation exercise with a trailing earnings, then look at from the current year's growth and probably next year's growth. But not completely not looking at last 12 months earnings would be bizarre. In fact, today morning I was looking at how much India is more expensive. So I was looking at all the markets. Like India is at 22 times, China is about 10-11 times, Hampshire is about 10-11 times, Korea is at about 12 times. So there is a huge gap at the market level. Of course, every market is different, like every stock is different. Prospect for India is supposed to be large and amongst the fastest growing country in next 10 years. That's the global kind of consensus view. Obviously, it will be a little more expensive. But I think the gap between where we stand and where the rest of the world, the rest of the other emerging markets, I think that's where the real problem is. We are like more like 12 and 20 type of gap is there. And the world might be willing to pay maybe 12 and 16 or 17. So I think that's some bit of outperformance of other markets, which is India, might be helpful in subsiding the FI selling, and hence normal course of Indian markets can continue.
You're saying based on trailing earnings, this India is still much more expensive compared to emerging market peers. Raamdeo, is that what you're saying?
Yeah, that's what looks to be on TTM earnings. What I look at wherever you get in the global portals, Bloomberg and all. So they are clearly. And second, what has happened is when I was talking to a few analysts in Hong Kong and all, they are saying that they had say 25% allocation on India, and the rest of the world markets collapsed. So actually India allocation has gone to around 25 to 35 or 37% in their portfolio. So the appetite to further buy India is not only over, they have to trim a little bit India to balance the portfolio, and that's how I think we are getting sustained selling on Indian portfolio from Indian portfolio investments. So something has to change from the current scenario. Either the valuations of other emerging market has to go up, or Indian earnings have to explode so that multiples can come down, or maybe the selling will make markets a little more, little less expensive. So this adjustment, valuation adjustment is on right now, and as the earnings are growing, multiples are coming down, and maybe it may continue for another quarter or two, and then normal thing will start.
Raamdeo, stay with us. I have many more questions. One, of course, is exactly this. I mean, this FII selling, right? How much is enough? Many people are making all kinds of assessments, and whether, well, it's already come to this level, so how much more can it be, etc., etc. A little bit about global stuff as well. So we'll take a quick break here, Raamdeo. Request you to stay with us. We are back with more on the other side. Welcome back. We are in conversation with Raamdeo Agrawal of Motilal Oswal Financial Services. Raamdeo, that FII selling point, right? Is there a lot more to go? And is there any way to know? Because we're looking at historical numbers in that period, that much was sold, and then comparing how much is done already. What is your sense?
So I am surprised by the sheer number, about 3 lakh crores of the selling in last 10-12 months. That has been quite unprecedented. So, I mean, they own about 20% of the market. That's about 50 lakh crores more they have. So they have enough to sell if they want to. And good thing is that, I mean, the thing is that they have option to go anywhere in the world. Whereas the Indian investors, when the participation is increasing, they have no choice but to invest in India. So this is a classic case where foreigners are kind of selling out of India because they find it relatively expensive, whereas Indians having no choice but to buy India, they are lapping up all the stocks which are coming from the FI selling. So this equation has to change someday, when I think FIs will start coming back. At some point of time they will, and but when, I really don't know. I mean, how much more is ahead for selling.
But do you suspect there is more?
Pardon?
But your sense is there is more to come.
Looks like. I mean, if nothing changes, then the current pace of selling might continue. I don't have any extra information per se, but it just seems that the valuation gap is, which is the reason for which there is no other reason for FIs to sell out of India except for the valuation gap. So somehow this premium of India, either they accept the premium, that is the way to go, that India will trade it almost 100% premium or 70% premium. That's the way it is going to be. So that reconciliation might happen, or they might say that we'll stay away from India till the premium goes up. So that argument, I don't know where it settles by.
No, got that. Got that. Just a quick point though. What can be different? Can something change? Because this seems like an almost pre-decided, deterministic kind of path, and markets rarely work like that, right? Inflation is a problem. Central banks are tightening, scarce money supply, so valuations will come down. So it almost is very deterministic. I mean, any thoughts there, Raamdeo?
Yeah. So one of the thing I was just saying is the India's export-import figure, which is now coming on a weekly basis. Now, first week of June, they have declared the thing where export grew by 27%. And import grew by 77%. And all the imports are commodities like oil, gold, and oil and gold mainly. So they are all kind of raw materials, and they have just gone through the roof. So I think this high import intensity and expensive imports, that is all going to build into the cost structures of a lot of manufacturing. So giving one earnings, I mean the cost push earnings, And at the same time, if you see the even RBI policy yesterday, they are saying that they are seeing heightened inflation of about 6.7 or 6.8% for next 12 months. But at the same time, the GDP growth of 7.2%. So you are talking about a nominal GDP growth of about 15-16%, which is totally unprecedented. So now we have to find the company. So I don't think there will be any problem for the top line growth in India. Now the only issue is which are the companies which are pricing power, which can pass on the cost and take the benefit of top line and operating leverage and increase the growth in the earnings. So I think so there will be churn of the companies which are going to be winning on the earnings side, and there will be companies which will be losing on the margin side. So things are changing. It's not that things are static, and so winners and losers will change.
No, got that. Raamdeo, let's come to what you like, right? You said that one has to be ready to act, right? You should know what are the price zones for individual securities that you're comfortable buying, and when the price comes, you must act.
Yes.
And then they can fall more. That's another point. But you should have done your work. So
Yes.
you've done your work. So tell us, what is already looking closest to being attractive?
I mean, clearly, few sectors which have not done well in last 3-4 years. Of course, the banking. So banking is clean and nicely growing. Credit growth you have seen is 11% plus. Their services, so the cost push will be limited to. There will be cost push, but less, and volume growth will be there of 15-16%. So that sector should do well in every aspect, clearly. Then you are looking at IT. I think rupee is going to remain at current levels or weaker if the current uncertainty continues. In that situation, Indian IT could be one place where there's a lot of pessimism, thinking that there could be recession in US and things like that. But my sense is when I talk to my contacts, they all say that right now the issue is about the managing the work, in the sense that getting somehow people to do the work. So there is more than ample orders, and it may last for years. So I would think that at some point, Indian IT is going to be one of the most resilient, high quality, sector. One should not, if somebody is not overweight, at least one should not be underweight. So that looks to be another place where one can put money. Insurance would be another one. I would be more inclined to be on the services side rather than manufacturing side, because manufacturing is a lot more material intensive, which is where the problem is. Whereas services are a lot less material intensive, but it has got more to do with the employee cost, interest cost, and those kind of things, which is much more manageable. So those are thoughts which are coming in the mind today, but only time will tell how things shape up.
No, the first sector you said, so you said a couple of IT, insurance, services, generally services. You started with banking, Raamdeo? Sorry, I missed that.
Yeah, we talked about banking also. Yeah.
Banking. Okay. And what will take for banking to start to perform, banking stocks, Raamdeo?
Just again, all the private sector banks are owned mainly by, predominantly owned by foreigners. So the continuous selling of the performance every quarter after quarter, you might have seen the Q4 also, Q1 also will be very good. So there is a continuous recovery. Credit cost is lower, their credit offtake is very good. So every aspect of banking is looking good. And just that the foreigners, they own too much of Indian banking, and that's where the selling is coming. So the issue in terms of the multiples of Indian banking is contracting because of sustained selling.
Okay, Raamdeo, it's a pleasure. Thank you very much for joining us here on CNBC TV18. Wishing you all the best for your conference and wishing you all the best for your health as well. Thank you indeed for being with us here. Look forward to another chat soon. Thanks indeed. We'll take a very quick break here. On the other side, we'll have our market coverage, which resumes. Mitesh Thakkar of earningswave.com for a technical view on things and of course more coming up in just a bit. My co-anchors, Pavitra and Reema Sumera, will also be in to take you through that.